A or B?
A lot of the decisions I've made from a career perspective are optionalities. I look at the asymmetry of outcomes. What's the downside?
Left or right?
The outcome of anything depends on two things. One is the quality of your decisions, which is skill plus luck.
Yes or no?
When you make the right decision and you get the wrong outcome, it was still the right decision.
Welcome to The Art of Deciding with Bruce Whitfield.
Hello, and welcome to The Art of Deciding, where we ask people who make big decisions to give us some insight as to how they do it. Making the right decision isn't easy. That's what this podcast is all about. And one of the decisions pretty much all of us has to make is what we're going to be when we grow up. And sometimes it's something of a false start.
I was just a fake engineer. I did the maths and the analytics and always had an interest in the broader arena. I enjoyed finance. So at the first opportunity, I left engineering behind. I joined a firm called Andersen Consulting, and I remember having a very long interview process where they were all trying to figure out whether I was going to stay. Because that's what they were asking. Are you going to disappear and do an MBA or not? And I said, no, I'm not going to do that because I think working in a management consulting firm is like getting a mini MBA on the job. And so why would I want to possibly go and do an MBA? And of course, 3 years later, I felt, actually, I think I need an MBA.
Arjun Raghavan was born and grew up in Chennai in southern India. He decided to go to the Indian Institute of Technology in Mumbai because that was the institution with the best reputation available. But it wasn't his calling. He did get that MBA from INSEAD in Paris. From his consulting days with Arthur Andersen, which became Accenture, he went on to become director at Quantiva Capital and is now chief executive of Partners Capital, a privately held asset management company partly owned by the Rothschilds, making decisions with billions of dollars at stake. What were the choices that got him there?
I made a couple of decisions, which I've reflected on a fair bit from a career perspective. The first one, when I was a management consultant, I really enjoyed what I was doing. I learned a ton. But I knew when I'd done it for about 7 or 8 years that I just didn't want to be a long-term management consultant, but I wasn't 100% sure what I really wanted to go and do. So, I did two things, both of which entailed a giant pay cut. We just set up something called the Accenture Development Partnerships, right? Which was really around providing consulting to foundations, endowments, nonprofits with a view that, if you can apply the business skills to nonprofits, maybe they can drive a lot more impact in the world. And so I was quite taken by the idea, and partly because I think I like a sense of adventure and I like to sort of get different experiences. I, took a 60% pay cut. I didn't have kids then, and I wanted to do 6 months there in this nonprofit consulting unit. If I really like it, I'd like to think about building a career there. So I sort of jumped in and I got projects that took me to different things. So I spent time in ostrich farms in the north part of Namibia. I spent time in sort of all kinds of different places in the south. My job was to train the team on how do you think about marketing, how do you think about putting together a financial projection, etc. I suppose it was the precursor to proper impact investing that we hear about today. But again, it was a fascinating experience and I learned a lot of things about myself, right? And one of the things I learned was I felt if you really want to have proper impact in the world, doing it at the age of 27 and sort of doing these sorts of stints is great from a feel-good perspective, but you're actually not going to turn the dial very effectively because you're not going to have the level of impact you could really have if you were a much more seasoned senior business executive. I really enjoyed it, but I've learned about myself that actually I do want to build a proper commercial long-term career, but I would like to come back to it, but at a stage and at a point when I can have significant impact. So that was one thing that I learned. But when you talk about decision making, to me, a lot of the decisions I feel I've made from a career perspective are what I describe as optionalities. I look at the asymmetry of outcomes. What's the downside and versus what's the upside? And I think it's a bit like investing. You're always thinking about, is the upside multiples relative to the downside? And then if I switch to then my move into finance, I got very interested in investing, and I found an opportunity towards the end of '05 in a small hedge fund, right, which was utterly different to what I'd ever done. But it was an ex-Goldman Sachs team. I really liked the people I met, and they were looking for someone who to add to the team, but who could also help build the business. And so the thesis was I would join. I'd learn the ropes in terms of investing and capital markets, and I'd add value in terms of operations and from a business sort of building perspective. And I just thought my degrees of freedom are going to close the longer I leave it. But here was an opportunity to get into the industry in some way. And I have no idea if I like it or not. I'll have no idea if this firm is going to be successful or not. And so, again, I took another giant pay cut. This is my second giant pay cut. And I had to work 6 days a week. That was the rule. And they said, well, you got to come in on Saturday because you don't know enough and you got to learn all this stuff. I said, okay. So I did that and I learned a ton, but it wasn't going to survive. Right. 2007 came in, markets got a lot trickier. And I looked at it, I just thought, I don't think this is going to work out. And it was sort of clear that it was wobbling. And also, I learned a ton about how it's actually not easy to build a career in investments.
It looks so easy from the outside, doesn't it? Because you look at the homes that drip down mountainsides, and invariably they're owned by various levels of asset managers. The further you go
Of
up the
course.
hill, the wealthier the asset manager is. There was a fantastic book from the 1920s saying, "Where are the customers' yachts?" From the outside, it looks like this wondrous honeypot.
Yeah.
What drew you into it that you were willing to take the risk of competing in a very, very aggressive industry?
Yeah, I was fascinated by it. The idea was to try and understand how do you invest capital effectively to get returns. And obviously, if you get it right, it's a very lucrative industry. So it is something that is very attractive as a professional from a career perspective. So there was always a sort of a learning aspect to the decisions I take. So again, you look at the options. What options do you generate? Because my view is, again, maybe I'll figure out actually my home should be in a private equity firm. My home should be in a multi-asset class investor, someone who does kind of this, but in a different context, right? Hedge fund investing is all about going very, very deep on a small number of things. And one of the things I learned about myself was I like variety. And so it doesn't excite me to know everything about 20 stocks in the telecom industry. And so when Partners Capital came along, it was you had the opportunity to interact with clients and run their client portfolios. Each one would be different, right? Different challenges. I had the opportunity to look at the entire investment universe, right from real estate through to mid cap stocks, through to private equity, to everything. And it was across the globe. So it had lots of different skills you needed, and it had the variety and the excitement of dealing with clients. And so, you know, I got lucky with finding something that suited what I really wanted to do very effectively. The way I sort of see it is I created the optionality, and it so happened that it worked out. But if you don't create the optionality, you just never know.
Exactly. And today you're chief executive of this firm. You've got 8 offices in different parts of the world. You've got 370 people. They're between 60 and $65 billion of assets under management. It's a chunky portfolio across multiple asset classes, across multiple disciplines. I think probably what is the most interesting is how we're seeing equity markets getting smaller and smaller. So the
Yeah.
old-fashioned markets of whether it be the Dow or whether it be the FTSE or whether it be any of the traditional stock markets are feeling like they're losing their relevance, and more money is going private into private equity. And you've got a fairly large and I think growing private equity portfolio where you go in and take stakes in private businesses. And 20 years ago, this was Wild West stuff, and it's actually become far more commonplace. And I guess you've ridden that wave, haven't you?
Yeah, absolutely. Probably 40% of what we do is in private markets. And it's not a monolithic asset class, right? So it's very varied within it. If you look under the hood, people know the big grand names of private equity, but actually there's a whole host of smaller firms and managers who are doing quite niche specific things. So it is a very varied asset class. But we think you're going to get exposures there increasingly, as you said, that are quite different to the public markets, right? Some of them are classic old style. You buy a company private when it's smaller, when it's a bit bigger, you sort of IPO the business. But there are plenty of large businesses and small businesses that remain private for good reason because they don't need the public markets for capital, right? You can do that in the private sphere. And in the private sphere, you have the ability to think a little more long term, right? You don't have to be swayed by the sort of the quarterly earning cycle. And so there are plenty of firms that choose to remain private for that reason. And getting exposure to very well run firms in the private sphere is very much part of what we do. There's a place for liquidity, and there are some good opportunities in the public markets, but it's always going to be a balance between the two.
When we look at the world and the uncertainty in the world, and uncertainty has been severely ramped up. I go back 35 years just because the convenient start date. The Berlin Wall comes down 1990, the opening of Asia and the opening of Eastern Europe, and it's a low level volatility in terms of uncertainty. And then since then we've seen these whipsaws in uncertainty from 9/11 to the global financial crisis to COVID to Ukraine to Gaza to the Trump election and the trade wars, which has led to a spike of uncertainty almost as high as it was during COVID. And as we speak, as we have this discussion, Israel and Iran are swapping missiles. It's a frightening place. How do you, as chief executive of a company that's got 8 offices dotted around the world, that's got this long-term mandate of capital preservation without performance built into it. How do you keep your head when all about you are losing theirs? Because it's a frightening world into which to be applying capital.
Yeah. Well, there's a very specific set of principles I think about, right, when you're making decisions. But the first point I'd make is the sort of the peaceful world we've seen to some extent post World War II until 2000, pre 9/11 perhaps, is actually a blip. The reality is that much of the world has been chaotic for most of its life, right? And there's been wars and there's been chaos, et cetera, throughout. So when you look at it and you think, oh my God, this looks terrible, actually, this is the norm of the world, right? So we've been, for the last 3 to 5 years, suggesting that, look, we've had a paradigm shift in terms of volatility and uncertainty, et cetera, but it's to some extent sort of back to the future because it's kind of what the world was like. The reality is that there's always a ton of uncertainty in the world. And there's a great framework that I've shamelessly stolen from a woman called Annie Duke, who's a very good poker player, by the way. So she's written a famous book called Thinking in Bets. And a very simple philosophical point that we try and remember is the outcome of anything depends on two things. One is the quality of your decisions, which is sort of skill plus luck. So everything is probabilistic, right? So when you make the right decision and you get the wrong outcome, it was still the right decision. And it's very easy to fall into the trap of judging a decision based on the outcome, right? But actually, in investing, and in life probably, but in investing in particular, it's really important to focus on the decision making framework, right? Like, are you making the right decision? Because if you repeatedly try and make the right decision and you're putting 150 chips on the table because you're making a number of different types of investments, I think the probability game works in your favor, right? And so when I think about decisions, at the firm that we need to make from a business perspective or in investment portfolios, that's what we focus on, right? And so how do you make good decisions? What's the quality of good decision making? Have you got the right data? Have you got the right analysis? Have you got the right people in the investment committee making sure that you're pressure testing the decisions you're making sure you're putting the right chips on? Let's take, a classic example, big sell-off in April, Trump tariffs. How do you behave? Like, what do you do? And how do you make sure that what you're doing is sensible from a long-term perspective? And those things all require discipline because we're all affected psychologically. And so when things happen, it's very easy to knee jerk. And our jobs are to sort of hold the hands of our clients and make sure that they can get through the volatility by being very rational. That's very, very critical. And I think you can apply that through history. Like the reality with wars and so many of these geopolitical events is that we looked at the analysis. For the most part, markets snap back, even if they drop off, right? They snap back within a 12-month period to the previous high.
However, you look at post the global financial crisis, it took nearly a decade to get back to pre-crisis levels. And so that was a difficult period of time. Then, you look at this recent Trump tariff fiasco, if you like, it's taken less than 6 months. There was the panic in and oh my goodness me, it's not going to be so bad. And everybody calmed down because as David McWilliams, the Irish economist who was on a couple of episodes ago, says, markets put manners on megalomaniacs. And sometimes you just simply have to trust institutions
Yeah.
and what is in place to protect against the extremes to ensure that you return to some kind of medium.
I think that's right. And even during the global financial crisis, you got back to a high if you were more diversified than just being in the equity markets. The global financial crisis was truly extreme, right? It was an extreme event. You think about COVID. I mean, COVID, it was so easy to think that the entire world is going to be dramatically different from here on. People will stop rallying, blah, 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 blah. And, 3, 4 years later, yes, we're doing more Zooms, but actually, a lot of it is back, right? So I just think human behavior, it just finds a way around. Hence our view that staying for the long term, diversify your bets, put 100 bets on the table as opposed to 3 and hope that it works, right? If you're diversified, you play the probability game, you're making good decisions, then usually it works out fine over the long run.
In 1990, the top 3 companies on the S&P 500, number 1 was ExxonMobil. Number 2 was IBM. Number 3 was either Walmart or General Electric, depending on which day you looked at it.
Yeah.
They were pretty much neck on neck. And these companies were worth around $60 billion each. Today, they are still significant companies. They're in the top 50. They haven't disappeared. But the top 3 today, Microsoft, Nvidia, and Apple, companies that were babies 35 years ago, and in Nvidia's case didn't exist until 1993, that have dominated the world. And so that narrative of human progress and human ingenuity, almost as Hans Rosling, who wrote the wonderful Factfulness, talks about, human progress is actually very quiet and very boring and very steady and doesn't take the headlines. And if you are only focusing on the noise and the headlines and the spikes and uncertainty the whole time, you miss what's really changing in the world, which is
Fully
progress,
agree.
right?
Yeah, absolutely agree. Yeah.
So does that give you confidence then in terms of investing in the decade ahead, where we look, for example, at country balance sheets that have been broken by the sort of the bailouts that happened during COVID and crises before that, and the global financial crisis, where central banks have printed new money and the US is sitting on $38 trillion worth of debt, and there's fears that the UK is at the tipping point, for example, in terms of its finances, and China holds a huge amount of the world's debt, and that's where the true power lies. That's the next narrative that is building for the next crisis as it comes, and maybe it is the next crisis, or maybe it's another black swan. How do you navigate that kind of future uncertainty that looks like it's a big risk, and it may or may not play out in a dangerous way? We don't know.
I think the fiscal deficits and country balance sheets definitely very challenged, right? I think we all sort of recognize that. But at the heart of it, we're not investing in the country's balance sheets. You're investing in companies. Now, they are going to be linked to GDP growth. They are going to be linked to how countries do. Um, but every sector is not going to get hit in the same way. So if you just take, for the sake of simplicity, equities, even if you invest in the US, you're saying, oh my God, the US, I don't know what's going to happen to the balance sheet, fiscal deficit, etc. Investing in a US company doesn't mean you're indexed to the US economy, right? You're indexed to the global economy. And the reason you're investing in US listed companies is because the governance is good, the liquidity is good, you can trade in and out effectively. You can pick businesses and opportunities and still do very well, even though the macro context and the fiscal deficits, etc., of a country might be more challenged.
So when you look at the long term, then you look at probabilities and the thinking of an Annie Duke and poker playing and placing bets and hedging your options on the poker table. The world kind of works like that. But you're also, I think, a big fan of Barack Obama and the way in which he sort of thinks about complexity, aren't you? I mean, does that sort of help frame you in terms of a value set as you consider the future and your A-type asset managers who all want to be seen to be performing strongly, consistently and well? Their incentives are tied to good performance, obviously, as well. How do you do it?
I think Barack Obama's, I heard him speak once, and his thinking is very much about decision making. He said, the world's crazy, it's filled with uncertainty. You don't have all the information, but you go to sleep and sleep well thinking you made the best decision you could with the information that you had. And I'd say one other slightly nuanced thing around the right decision. Some of it is dependent on the client. For example, there are times when there are very rational decisions that you could make in terms of upside, downside. You look at an investment, you could say, look, if it goes wrong, you can lose 20%. If it goes right, you could make 200%, whatever it is, right? But there's something called a utility function for people, where it's behaviorally known that people feel pain of loss much more acutely than sort of the excitement of gains. So there are times when, even though you look at it very rationally, for particular clients, from their utility function standpoint, you don't want to be holding a certain investment for any longer, because even if it loses another 10%, they're worrying about it. If it loses another 10%, it's going to make them even more worried. And you just sort of, at times, you have to say it's not worth the pain that it's causing them. And I think initially we were a little too sort of rational in our thinking, saying that's not how you should be thinking. But, over time, you realize that actually you're dealing with behaviors and human beings, and you have to make decisions with a slightly broader mindset at times. So it's sort of the same concept of try and make the best decision you can make. You can't control the outcome, but you can control the decision you're making.
Don't be afraid to cost yourself money. Take a pay cut even, to explore new things and learn what you need to learn to discover what you really want. Create optionality, in fact. The world's default position is uncertainty, chaos, flux. To deal with that successfully, play the probability game. Spread your bets and make a lot of them. And just because you got the wrong outcome, it doesn't mean you've made the wrong decision. Be rational. Base choices on facts, not feelings. Play the long game and channel Barack Obama. Sleep well, thinking you made the best decision you could with the information that you had. You can't control the outcome, but you can control the decision you're making. Arjun Raghavan's Art of Deciding. Thank you for listening to this edition of The Art of Deciding. This is our last episode for a while, the podcast taking a summer break in the Northern Hemisphere and hibernating or wintering in the Southern Hemisphere, depending on where you are, of course. To keep you going, I really do encourage you to go and check out our other episodes. You will find them in that wonderful place, wherever you get your podcasts. You know that place. If you're bookish, there's the best-selling Jack Reacher creator Lee Child, Booker Prize judge and author Sarah Collins, and broadcaster Jeremy Vine talking about, amongst other things, his decision to write cozy crime. If you're into the psychological, then check out the lead Anders Breivik interrogator Asbjørn Raklu, Professor Robin Dunbar, he of Dunbar's Number, and Sam Rocky talking about successful decision-making in groups, or Nuala Walsh on clear decision-making in a cluttered world. Or if it's more economics that you're after, we've got a lot of that too. David McWilliams on how the choices around money have shaped the world, Professor Cass Sunstein on nudging, and we even have a look inside the head of one of the world's most successful decision makers ever, Warren Buffett. I'm Bruce Whitfield. You can find out more about me on brucewhitfield.com. Bye-bye.